We now move to our first panel, which is Multinationals, Changing Form of Tax Competition in Corporate Taxes, which will examine how multinational corporations are adapting to shifting global tax dynamics, which is particularly relevant in the wake of discussions on international tax reforms. Moderating this discussion is Elodie Lemaire, who is a journalist at Tax Notes. So Elodie, the floor is yours to introduce the discussion. And please welcome.
Okay, this is on. Hi, everyone. Thank you for being here. I think you'll be happy to hear that I'm going to shorten my introduction because we're already a bit of running late. But there's a couple of things that I want to mention just to set the scene, a couple of recent developments. So as we know, international developments are making the news every day right now, and there's the big question mark of the US. I assume that you've all seen that the Polish presidency of the EU Council circulated a few options of how to actually allay the concerns of the US regarding Pillar 2. I guess we'll discuss this later, but the European Parliament made a couple of amendments to a draft report last week, commenting also on these options. And then last week in Washington, at the American Bar Association section of taxation meeting, Rebecca Birch, Treasury Deputy Assistant Secretary for International Tax Affairs, actually said that extending the existing UTPR safe harbor and considering guilty minimum tax rules in the US equivalent to Pillar 2 wouldn't be enough. But she also mentioned wanting the US system to stand side by side with Pillar 2, and she also challenged the premise that, and I'm quoting, the agreement of Pillar 2 is a country-by-country 15% measurement. So I'm really wondering what exactly the US want. Maybe we all wondering, I don't know. And then parallel to that, we have this decluttering effort that is ongoing, and it's interesting also because I remember that the first person to use the word decluttering was actually Hakim Prost from the OECD, who said now that we have Pillar 2, we could declutter the tax system. So Pillar 2 was really the trigger, I guess, of this decluttering exercise. But if there's uncertainty on Pillar 2, what's going to happen to the decluttering exercise? So I guess this might be also a conversation for us today. And then last but not least, last week the EU Tax Observatory released a policy note on the downsizing of effective tax rate. I'm not finding the right word. Declining. Well. So I guess we'll start with that. I'm just going to introduce my panel. So we have with us Sarah Godar. She's a postdoctoral researcher at the EU Tax Observatory, and she's based at the German Institute. I'm sorry, I lost my voice last week. German Institute for Economic Research. Next to her, we have Benjamin Angel, who's Director for Direct Taxation, Tax Coordination, Economic Analysis and Evaluation at DG Tax Sud. And then we have Kira Marie Peter-Hansen, your Danish MEP and Vice Chair of the Fisc Committee. So I'll give a few minutes to each panelist to make introductory remarks. And I hope that we'll have a bit of time at the end for Q&A with the audience. And I hope that you'll be sharper than me because I'm a bit jet-lagged. So I'm counting on you for questions later. So we'll start with you, Sarah. If you could maybe say a few words about your policy brief and your research.
Yes, thank you for giving me the opportunity to summarize the research that we did at the EU Tax Observatory, and it's a joint research paper with Jules Doucet, where we analyze more than 300 tax reforms that have been implemented in the European Union between 2014 and 2022. And we find that corporate tax policy making in the EU has shifted away from or seems to have shifted away from the cut rate, broaden base approach, which was a major recommendation by international institutions such as the OECD in the 2000s. And instead, the majority of reforms implemented were actually tax-based narrowing reforms. And this doesn't imply that the tax rates haven't decreased as well. So we see statutory tax rates declining, and on top of that, we see base narrowing measures being implemented, among which, like many of them were cost-based investment incentives, but we also see research and development incentives, intellectual property regimes. And we see that the statutory rate declined, but the effective tax rate paid by multinational affiliates in the European Union has declined even more in the same period. And in the study, we tried to analyze the contribution of the tax reforms to this decline of the ETR. And we find that the statutory rate, of course, has contributed to the decline of the effective tax rate, but the tax-based reforms had a net negative effect on the effective tax rate as well. So we had base broadening measures as part of the anti-avoidance packages implemented in the EU, but those apparently were not sufficient to counteract the negative effect of the base narrowing measures that were implemented at the same time. And then we calculated altogether the EU governments forego deliberately 3.5% of the tax revenue that they could have collected in this period. And this might look small compared to the numbers that we deal with when we talk about profit shifting, where we talk more about 10 to 17% of revenue losses. But the point that we are trying to make is that this comes on top of revenue losses due to profit shifting. Governments have, on top of that, cut corporate taxes and deliberately reduced tax collection. And then in the debate, often we focus, rightly so, on the extreme players, such as Ireland, with the capital allowance for intangibles, which allowed multinationals to pay very little tax in Ireland. But at the same time, we see a process where the high-tax countries implement more and more reforms that slowly reduce or weaken the bite of the corporate tax. And actually move the effective tax rate in high-tax countries slowly towards the minimum tax of 15%. Yeah? So we have reached 18% on average as effective tax rate in the European Union. And we think that this is problematic, and we want to show, or kind of my conclusion from this research was to say that we need to think about or weigh the cost of this uncoordinated policy making due to tax competition in the EU, and weigh it carefully against the expected benefits that individual governments hope to obtain for their domestic industries, while these benefits are not even sure because the multinationals can also shift their investment between countries, and the one incentive that looks attractive today can already be replaced by a more attractive incentive in another country the next day. Yeah, so I think we should consider becoming a bit more positive about tax harmonization in the EU beyond the anti-avoidance policies. Yeah,
thank you. Benjamin?
Thank you, Elodie. I think what has highlighted Sahara is an interesting phenomenon, but obviously one has to be always careful about averages, because it says very little about the dispersion to the average. And in reality, in the European Union, the CIT scenario is still extremely diverse, actually. On paper, the statutory rate range between 9 up to 35%. And the effective tax rate is also quite different. Usually, the narrowing of the tax base is a phenomenon when you see a lot in countries which tend to have a relatively heavy taxation and relatively complex tax code. And then they try to correct it by a number of policy measures which do not contribute to simplifying the tax code, that for sure, but that have for effect to reducing a bit the tax rate. Commissioner Roekstra, as Gerasimos has mentioned, has indicated that one of his priorities will be fighting the tax gap. And as part of this fight against the tax gap, we need also to have a better understanding of the policy gap. That is the one which is deliberately created by measures narrowing the tax base, be it for the corporate income tax, but also for other taxes. If you look at the last report from the Commission on the next report of the Commission, when it will be published on the art, it has something on the policy gap. And for VAT, for instance, the total policy gap is around 1.2 trillion euro per year. 1.2 trillion policy gap. We're not talking here of fraud. So clearly, I'm not saying that those measures are bad, by construction, but when you take measures to cut the tax base, what is key is to do a regular health check. That is making sure that the reason at the origin of the decision is still valid and that there is still value for money in the decision to cut the base or to give tax credit. And sometimes it is the case, sometimes it's perfectly sound, sometimes it's just completely outdated. And too often decisions are taken and are not revisited. So that's something that all member states should do, revisiting regularly the rationale of the measure which they have taken to narrow the tax base. And when they can conclude that they are not delivering the benefits that they were hoping for, maybe it's a good occasion to reconsider them.
Thank you. Kira?
Thank you very much, and also thank you for inviting me. It's very nice also to see how much progress we've done in the field of taxation and with the Tax Observatory. Just going a little bit of a step back, my starting point from the side of the Greens IFA is to discuss first why do we tax, with what purpose, and for me I would say there are two main purposes. One is to ensure revenues. We have a lack of revenues. We need investments for defense, the green transition, our healthcare sector, as other speakers were also discussing. So there's a revenue gap that we need to address that we can't do without taxation. And then there's discussion of fairness and redistribution. And I think here this is where it also comes into play when we are discussing corporate taxation. My starting point is that having a much lower taxation rate for labor is unfair compared to the taxation rate we have for corporate taxations, wealth taxations, or inheritance tax. So ensuring that balance in our tax system from a fairness perspective is important. And then I would say the other principle that is guiding this discussion for me is to ensure a rule-based order in whatever we are doing. So whether we're discussing a trade war, a war in Ukraine, war in Gaza, tax wars, we need to ensure that the international agreements we do commit to and the rules that we do commit to, all of us on a global level, are actually also met and that we're following through on them. So that's my starting point, and then my conclusion comes to then what we need to ensure when it comes to multinationals and the changing forms of tax competition is that we need to ensure healthy competition, that it's not competition on the basis of just a race to the bottom, undermining the tax base for corporates, because that undermines the fairness aspect. It's not a tax competition where we then say, well, these international agreements we've had, we just forget about them. We do our own thing, neither in the EU nor in the US or nor other jurisdictions. So it's a system where we can count on what we've discussed and what we've agreed on. So that's the starting point from where I am, and then I'm looking very much forward to the discussion.
Thank you. You're all speaking without sheet of paper. I feel a bit bad because I would be lost without mine. I suggest we would start with tax incentive, because the EU Tax Observatory policy brief actually, if I can quote, says that when it comes to IP and research and development tax breaks, it says that it's possible that these regimes merely increase tax competition without having any real economic effect. And then the policy brief also calls for a thorough discussion on Pillar 2 tax incentive. And so I was wondering what features should these incentives have to ensure that they do not become a vehicle for tax avoidance? Starting with you, Sarah.
Yeah, I mean, I think we have seen research, for example, by Nadine Rieder that shows that some that multinationals can also react easily to R&D incentives implemented in different countries and actually move their research and development location without increasing research and development overall in the whole group. So I think we have to be very aware of this risk of chasing R&D and attracting it maybe from some neighbor country. So for the EU as a whole, this wouldn't make very much sense. And second, I think that potentially all tax incentives can be used for tax avoidance, especially because many multinationals still operate in countries where effective tax rates are higher than 15%. So even with the global minimum tax incentives can be used to avoid paying more than 15%. So I think the global minimum tax is a very good progress, but it doesn't keep us from discussing why we allow multinationals to pay less than 20%, less than 25% in some countries.
To the Commission, to Benjamin Angel, the Clean Industrial Act actually promotes the use of tax incentive, but then within the Code of Conduct on Business Taxation in the Council, there's been a discussion about reinterpreting the economic substance requirement for certain kind of tax incentive. And then in March, at the European Economic and Social Committee, you said that, and you said that earlier actually, that an important part of the tax gap is the one created by deliberate policy decision. That's what you call the policy gap. And you said that too often tax cuts are a shortcut for uncreative politicians who think they can achieve miracles without doing the hard work. Sorry, I don't have a good memory, but my archives do. So I'm wondering how we can strike a balance between Pillar 2 rules, the need to close the policy gap, and then the need to give a boost to the industrial policy in Europe.
Let me reassure you, despite the appearance, there is some form of consistency. So let me try to explain. First, Pillar 2 is there to create a floor for tax competition. As such, it does have for effect in some extreme cases to recapture tax credit that were granted. And that is an effect that it has in all jurisdictions. Some are a little bit more vocal than others at the moment. But the truth is, even in high tax European countries today, you can have pocket of companies whose effective taxation is below 15% because of the accumulation of tax credit. This is typically the case, for instance, in the research sector, where member states tend to accumulate a lot of tax benefit. So first, Pillar 2 is there to ensure a floor and will make sure that there is not an excessive use of tax credit. Then when I said that too often tax credit are a shortcut for
Uncreative politician.
whatever I've said, the discussion was on investment. And I was making the point that investment decisions are taken based on a vast number of elements. If you want to invest in a country, you need a well-trained labor force, you need good infrastructure, you need cheap energy, you need flexible labor law, and one should not forget, you need rule of law. When you invest your money, you need to be sure that if you have a problem, you can go to a court and get a fair decision. Taxation is an element in this equation, but it's only one element. If you don't have the other element, you won't take this risk, you won't invest. And this is where the difficulty is for all member states and for all countries in the world. There is a balancing act between those two. There is a decision to be made. If you want a good education, if you want good infrastructure, you need public investment. You cannot have public investment without a sufficient level of public resources, which is taxes. So if you have a problem of competitiveness, jumping to the conclusion, I cut my taxes and that's it, the investors will flow, most of the time is the wrong conclusion. It is a much more complex problem. And if you look at today in the European Union, which are the countries which attract the highest level of foreign direct investment, these are the countries like France, for instance. France is definitely not a low-tax country. So that shows my point, which is it's a complex equation. Tax is just one element, and it's just too easy sometimes to go for the easy solution, which is cutting taxes, hoping that it will do the trick. In reality, it is more complex. Now, is this inconsistent with the fact that the Commission is about to recommend some tax measures to support the clean industrial deal? It is not. We are not saying that taxation is not a useful tool. We're saying not all forms of tax credit are effective and smart. Some work less. We can recommend some good practices, but even when we recommend good practices, it is important that member states do regularly check the efficiency and performance of the other tax credit that they have. In other words, we need to balance targeted measures to support the priorities of the moment, the Clean Industrial Deal, defense, which is also certainly a major priority, with other measures to review regularly the efficiency of tax expenditure. That is sound policy to make sure that when you spend money, there is an effect. And let me give you an anecdote which I like to give because it illustrates a bit why is the fact that sometimes measures of tax nature tend to stay beyond what is necessary. A couple of years ago, we revisited the VAT reduced rate. And in Luxembourg, there was a reduced rate for a fundamental component of the Luxembourgish economy, no doubt, which is rabbit fur. And when we asked the Luxembourgish, why do you have this reduced rate on rabbit fur? No one could even remember. So that's a demonstration by the absurd that member states should revisit regularly all the policy gaps to make sure that they are still justified by the economic priorities and the circumstances.
VAT reduced rate is actually a lot of fun. If one day you're bored, just go and look what exists. It's really fun. I have a quick follow-up because I think you said that you expect either country-by-country chapter on tax incentive or something in a report later this year. Are you going to, what's going to be in this report? Are you going to assess the effectiveness of tax incentives in EU countries, or how is it going to happen, the monitoring?
Sure. We are working on creating a new country-by-country report whose primary focus would be on the tax gap, and tax gap covers both the compliance gap and the policy gap. You already have some work which is taking place on tax expenditure, both within the OECD and at European Union level. But here we are really in the process of preparing a country-by-country approach so as to trigger targeted discussion with member states.
Thank you. Kira, last week in the amendments you put forward for the report on the draft report on the role of tax rules in competitiveness, there's a couple of things on tax incentive. For example, you proposed the creation of an EU framework for corporate tax incentives to streamline and ensure incentives are well designed to meet policy goals without eroding tax revenues. What type of guidance would you expect from the Commission or the Council or the Code of Conduct or?
Well, I would expect some of this guidelines. So, for example, saying that the rapid exemption is not making sense. But what we aim to do in this report and also in the FIS committee is to show, to play constructively into how can we also ensure harmonization in tax policies in order to also boost our competitiveness, and linking that to tax incentives. I think it's, for example, what you were saying, we see a lot of tax credit when it comes to R&D, but we don't see a lot of investments in R&D. So clearly the tax incentive is not working, at least not for its purpose. It might work when it comes to lowering tax rates, but for the purpose it's built for, it doesn't work. It just creates added complexity, and that's what we see with some of the tax incentives. It distorts the internal market, it creates complexity in an already complex tax system. So what we're aiming here to do is to call on the Commission, which we often do, to say, you need to do something, but also show how can we then build a more coherent tax framework. I think here also unanimity plays a role. We've discussed that at several tax events, but this is clearly something where we are lacking, because then we can't move to a uniform, more uniform tax system. And then in general, what we also try to tackle in this report is that we have a lot of legislation when it comes to, for example, state aid rules. This is highly, we've tackled the competition of state aid rules, at least until now. But we then have new tax competitions when it comes to tax credit. So that's what we are trying to solve. And then I want to thank you very much for reading our amendments.
It was actually my colleague Sophie.
Yeah,
I just read her story. one last question on this topic again for the Commission. I'm wondering, I know that France recently actually made a thorough assessment of their tax incentive, and I think I can't remember the figure, how many tax incentives they found which were actually useful only to a really small number of individuals. And I'm wondering whether other member states, whether you see that member states are actually willing to have this discussion, or that it's something that it's their sovereignty. They don't want Commission to put its nose into the tax incentive affairs of I don't know.
Well, the Commission has been developing assessment and analysis on this topic for a very long time. The report that we're preparing is just a new targeted development, but it's not that we're discovering the topic. Mm-hmm. If you take the European semester, for instance, you will find in many country reports critical assessment by the Commission of some existing tax schemes. Let me criticize my own country, since I'm French. In the French country report, the system for research credit has been criticized by the Commission for its high cost and relative inefficiency for almost a decade. So what we need is country to make the effort. The difficulty, as I mentioned before, is that once you give an incentive, it tends to stay. It tends to stay for several reasons, because obviously those who enjoy it, benefit it, are defending it, and because there is a political cost in challenging it, and sometimes also because just people forget about it. They just don't have a mechanism where they revisit regularly the decisions that were taken to check whether a decision which may have been perfectly valid and sound at the moment where it has been taken is still good and efficient. Maybe not.
Turning to Pillar 2, so as I guess you all know, the policy options proposed 3 weeks ago by the Polish presidency, but I will quickly remind them. So there's dropping the refundability test under GLOBE for tax credit and replacing it with substance-based condition for qualified refundable tax credit, limiting the application of the UTPR, or considering guilty regime equivalent to Pillar 2, whether or not there will be legislative change in the EU. And I was wondering, Sarah, starting with you, what advice or warning would you offer as the EU enters discussion with the US on these options?
Yes, I mean, definitely, I think that any watering down of the minimum tax, that would limit the applicability of the global minimum tax to US multinationals would be very problematic. And I mean, we have to look a bit at the broader picture that US multinationals are among the most aggressive profit shifters. They control a large share of intangible assets, intellectual property globally, and that share is going to increase with the use of artificial intelligence. I think there are a number of economists, among which Mariana Mazzucato, that are warning that with the rise of AI, the share of profits that US companies or these owners of artificial intelligence will extract from the other industries as a rent will increase over time. So I think the share of profit that will be subject to European tax over the medium term risks to decrease if we don't manage to tax the digital economy. Then we will find ourselves with a decreasing share of global profits. So we have to ensure that the digital economy is also taxed in Europe. And I mean, the US Congress was already opposed to the global minimum tax before Donald Trump. So it's not very clear what has actually changed. And the EU would very much be able to apply the global minimum tax to US multinationals, even without the consent of the United States. So I think now that we are in this trade conflict that arises because of trade problems, we should solve these trade problems first. That maybe tell Germany to reduce its current account surplus, which creates problems for the US, which creates problems for the European Union, but not trade a short-term benefit for trade policy against this major achievement that we have obtained in international tax, that is a global agreement, like unprecedented global agreement, which for the first time provides an alternative to the broken arm's length principle in corporate taxation, that I think it would be the worst idea to give in to the US in this point and say, okay, we will not tax US multinationals with the under-tax payment rule, because this is the core of the global minimum tax, is that if the headquarter country doesn't collect the minimum tax, the European governments can collect it.
To the Commission. You're telling me if I'm quoting you well, but I seem to recall that at an IFA lecture in March, you said that the issues raised by the US were primarily technical in nature, but when you look at the options presented by the Polish presidency, they have quite wide political implications. So I was wondering if the Commission would be ready to actually propose an amendment to the directive, and if there's any kind of options that it's leaning to, or that it's a no-go for the Commission.
Let me do one step back first and maybe agree to disagree with Sarah. I do not think that the United States are against the global minimum tax, and I don't think it is a statement one can make. As a matter of fact, Pillar 2 was a US ask. You have to remember the historical sequence. The creation of a global minimum tax is very much stemming from the initiative of the first Trump administration to create GILTI. And it is precisely because they had GILTI, which in practice was creating some kind of competitive disadvantage for the US headquartered MNEs, that they started to have an interest for a more widespread system of minimum tax so as to level the playing field. So the US are not against Pillar 2. What they are after is some form of coexistence between globes, the OECD G20 system, and GILTI. The modalities of this coexistence is what is being discussed at the moment. The discussion has started within the relevant committee of the OECD. I don't want to anticipate or speculate on the outcome of this discussion. As far as we are concerned, Pillar 2 is legislated, and we have to keep in mind that we are not the only one in this situation. The European Union has Pillar 2, but so does UK, so does Canada, so does Australia, so does New Zealand, so does Japan, so does Korea. There are plenty of countries which team up with us somehow in this discussion to ensure that we collectively do our best to preserve Pillar 2 and its integrity. We have no plan whatsoever to drop Pillar 2, while ensuring what the United States want, which is a more fine-tuned form of coexistence between those two. How it will be developed, be a bit patient.
But, I mean, when you look at the directive right now, if we were to discuss equivalence with equivalence for GILTI, the directive actually prevents us from doing that, because it really says we need jurisdictional blending, and GILTI doesn't have jurisdictional blending. So in any case, either you do not accept GILTI as it is, or you amend the directive.
There are a number of options. Again, I do not want to prejudge the option that will be decided at the end. This discussion is just starting. It's important also to keep on your radar screen the domestic discussion in the United States, because they're having this year a discussion on what to do with GILTI. GILTI in the legislation was supposed to increase to an effective tax rate of around 16.5. A draft legislation has just been presented to Congress a few days ago that would prevent this increase and would maintain GILTI at the current level. but the discussion in Congress has not taken place yet. So I don't want to prejudge the outcome of this discussion. I just mention it to highlight the fact that there are a number of elements that we don't know that may influence the choice of options and avenue to follow at the end.
Yeah, but when you look at what the US is actually saying, it's like they want all options. Is it a possibility for us, like we would agree to everything, or it's one or the other?
Well, the United States are free to make statements. Other countries which have laws in place are free to agree or disagree with this statement. This is a discussion taking place, and you need to give time to this discussion.
Sorry, I still have questions on, but I remember, I think at the EESC conference, the Tax Foundation actually explained that guilty, even though they don't have the jurisdictional blending, it's more stringent in some aspect than actually Pillar 2. So could we say, is it possible that we would say that we would not look at what kind of blending they have, but is it as effective globally?
There are a number of differences, indeed, notably the treatment of foreign tax credit or the substance carve-out. So that makes a comparison guilty globe just rate to rate relatively not straightforward. But again, and I will not deviate despite all your efforts, Elodie, this discussion is just starting, and it would be highly premature to consider that any option is preferable to another.
One last attempt.
While preserving the integrity of Pillar 2. We have no intention to drop Pillar 2.
Okay, two last attempts. When we negotiated CRS at the OECD, it was because the US introduced FATCA, and it's kind of the same situation. And FATCA operates next to the CRS. So I'm wondering if this kind of set a precedent to what might happen for Pillar 2.
I would be interested to read your papers.
And so my last question on this, what was it? Oh no, I lost it. Okay, I'll turn to Kira, and the last question will come back to me. In your amendment to the draft report, you deeply regret the options put forward by the Polish presidency and urge member states to implement Pillar 2 in full. But I mean, we could have faced tariff and everything, and I'm wondering what would be your recommendation to actually avoid a trade conflict while preserving Pillar 2?
Well, I would stand steadfast as we're doing now. I share very much the concern that Sarah also mentioned on us watering down our agreement, and it comes to what I mentioned in the beginning. For me, agreeing on international, or like keeping international agreements, needs to be the foundation. If the US doesn't want to play by the same rules as all other countries when it comes to trade, when it comes to OECD agreements, they can do that. But we can still manage to uphold the values that the Western economy is built on, and I think we should do that. And then I think also one concern I might have, and maybe there are possibilities I don't see, but if we start reopening these discussions, they can also go on for a very, very long time, and we don't know where they end. And I share very much the concern if we start trading parts of EU legislation in the idea of lowering the tariffs again, that is very dangerous. And I want to also take us back a little bit. Do you remember where you were in July 2021 when this agreement was? Like, for me, this agreement is one of the things I'm most proud of as a European and as a person engaged in taxation. And I see also Tobe being like, no, but what about the global south? And especially there are issues with this agreement. But after so many years managing to actually agree on an international tax agreement is a historic thing. I was at Plux, so I could also celebrate it a little bit. But I think if we start going back and just starting all over, that's a really big risk. And I think if we open up, we open also up to that risk.
Can I make just one remark to Kira?
Where were you?
No, I was very happy as well.
Yes. Yes.
That certainly is the most important text in EU law on taxation to date. One has to keep in mind that our position is actually a position where it is legislated. So for as long as the discussion continue, the default rule is the existing legislation.
Yeah, then we just need to enforce it.
No one has a plan to suspend the law.
Yeah, but there's been call to suspend the Pillar 2 directive from business, from Insurance Europe, from some countries even.
We have read those calls, obviously, but the law is the law, and we are committed to engage in earnest with the United States to try to find a practical solution to ensure a smooth coexistence between the two systems while preserving the integrity of Pillar 2. But the law is there.
And to finish on this topic, and maybe Sarah, you want to add something? No, you want. I thought you wanted to take the floor. Sorry. Last week, the UK and the US came to a deal on tariff and so on, and I think to have read that DST was not changed at all, and I was wondering if you would take it as a good sign that it's for you, Benjamin Angel. Do you think it's a good sign that the UK didn't budge on DST and that maybe DST can coexist in a world without trade wars? Yeah.
We don't have full clarity on this discussion. We have also 4 member states with DST. The UK has DST, Canada has DST. Actually, you have countries with DSTs around the world. And EU has done actually an interesting study on this topic last year. The United States have a long-standing animosity towards DST, which is quite a bipartisan one, so it's not a Republican thing only. And Pillar 1 was supposed to be the answer to the issue of digital taxation. And Pillar 1 was coming also, if you remember, with a commitment from jurisdiction having a DST today to roll it back. It has taken far more time than we hoped for to have a deal on Pillar 1. The rollback standstill commitment has expired in terms of calendar. Now, the important thing and the good news is that the United States have reiterated their commitment to work within the OECD on trying to find a solution on Pillar 1. I'm not naive. I know it will be a very difficult discussion, and experience shows that we have thought we were very close a number of times already. But it's certainly better than the alternative where the US would say that they're no longer interested. That is not what they're saying.
Turning to the last topic before I open the floor for a short Q&A on simplification / decluttering, starting back with you, Sarah. So we're actually assessing the anti-tax avoidance directive, and we're thinking that if there's overlap, there are some rules that might actually be relaxed. Do you see any issue with amending the anti-tax avoidance directive and potentially relaxing some anti-abuse rules in light of Pillar 2?
I mean, I definitely agree that if there's a duplication of anti-avoidance measures and Pillar 2, then there should be a relaxation or a removal. But in many cases, we see that the anti-avoidance measures target other groups or a little bit slightly different problems. So, like we have an upcoming study by Alice Chiocchetti, actually, which will discuss this in more detail. But we know that, for example, the CFC rules apply to all multinationals. So not only the multinationals above the threshold of 750 million of turnover, to which the pillar, the minimum tax applies, and the estimates are, I think, these are about 20% of the taxable profits are in these smaller MNEs. And if we remove the CFC rules, because we think Pillar 2 is now in place, then we basically allow these small MNEs to do whatever they want, and we don't want this, I think. And another problem, or another advantage maybe of the CFC rules is that they don't allow to get away with tax incentives. So if the effective tax rate is lower because of certain tax incentives, this wouldn't be compliant with the CFC requirements. Unlike some tax incentives that are compliant with the global minimum tax. So I think we have to be very, very careful and make a thorough assessment rather than saying, the global minimum tax will solve all our problems.
Benjamin Angel, the Commission is assessing ATAD. I think your assessment is expecting later this year, not a proposal, but the assessment. Is there anything that you can share? I know that I think you said that CFC was the CFC rules were like the low-hanging fruit in this. So is there anything you can share? And can you tell us as well if this whole uncertainty around Pillar 2 is actually having an impact on the ATAD assessment?
Well, it should have an impact, for sure, because we are reviewing the whole architecture of the EU tax legislation to look for possible overlap, both in terms of procedure and mechanisms, but also from a teleological point of view. That is, two measures constructed differently, but which have exactly the same purpose. That said, as Sarah has mentioned, Pillar 2 covers only the tip of the iceberg. It covers only the biggest M&Es, and very often the rules that we have cover a much broader set of companies. So it's not because we have something under Pillar 2 that suddenly we should drop our vigilance and stop preventing aggressive tax measures for other form of jurisdiction. We are in the process, indeed, of evaluating ATAD. I think the evaluation should be released somewhere in the autumn. So you have to be a bit patient. Beyond the question of CFC, it's important to look also at the interest rate limitation rules. That's typically a rule for which we have had very little during all the period where we had extremely low interest rate, and suddenly with interest rate which get much higher and unfortunately, probably to stay, there is a bigger question mark, and many stakeholders wondering whether adjustment of the rule would be needed, and that's something we need to look into. We're also looking at the experience with the general anti-abuse rules, and it's like for all anti-tax avoidance mechanisms. Let me stress that it's extremely difficult to do a correct and exact scientific evaluation, because I don't know. Okay, see, there's an alarm bell. When you do an evaluation, you try to measure things, and very often, and I'm not talking here of ATAD specifically, but of all anti-tax avoidance legislation. Part of the effect can be seen and measured. Part of the effect cannot. Let me explain. Take DAC 6, which is not the most popular piece of legislation among tax advisors in Europe, a piece which is widely criticized for its relative unclarity and complexity. You have the things you can measure, how many reports were made, from which country, etc. And you have the things you cannot measure, and which are here in a number of countries, which is there are some arrangements that we don't make any longer just because we know that we would have to make them public. And it's difficult to measure it because it's measuring something you cannot observe.
Kira, I'm still quoting from your amendment to the draft report, but you suggest that member states should work toward a more consistent interpretation of direct and indirect tax legislation, and you call on the Commission and the Council to consider establishing some sort of European tax agency. So we remember from last year, 130 academics actually asked the Commission to propose a new tax agency. There's a lot of concerns also in the ATAD public consultation, the feedback that member states are gold plating, are going further than the rules, and how do you envision a more consistent interpretation of tax legislation?
Well, I think the idea would be that it works a little bit like we see the European Banking Authority doing. So establishing guidelines on how to interpret and implement different tax legislation. And I think it's very crucial because, as you also mentioned, Elodie, the member states are complaining that tax legislation is complex. Business are complaining that tax legislation is complex. But quite often member states don't want to adopt the legislation that would actually simplify. Like I was the rapporteur on the transfer pricing directive, especially aiming at trying to interpret uniformly the rules. But member states don't want to do that. So maybe they could be okay with having guidelines from the Commission then. But again, where we want to go is to ensure that we have uniform interpretation of tax legislation and also harmonization of the tax rules in general.
And one last question from me, again to the Commission on this specific topic. The Dutch and the German issued a position paper where they call for actually some sort of panel to give stricter interpretation of tighter interpretation of EU directive. Valdis Dombrovskis also said, oh, we can have minimum harmonization directive, we can have maximum harmonization directive. So what do you think could be the future? Could we have some sort of panel or the Council Working Party giving actually binding interpretation of EU directive to make sure that there's no gold plating or that countries actually implement the rules the same way?
Well, having more guidance is certainly the way to go. That I think we can all agree. That's something that exists for already a very long time in the area of indirect taxation, thanks to the work of the VAT committee. Even though it's not a binding guidance, even the VAT committee, but de facto it has a very strong influence. For direct taxation, it is still relatively new. And actually, Pillar 2 is the first legislation for which we have done a systematic effort to provide guidance. We have gathered the member states during a year. We have discussed with member states all their questions, and we got around 450 different questions. And we have tried to agree on a common answer, which then we have published on the Commission website. It's a huge investment in time, but it pays off, because then you get less problem when member states transpose a directive, because they understand it better, they know what they should do, not do. So we plan to make a systematic effort to have guidance discussed with member states. It's not only the Commission in an ivory tower. It's important that this exercise of discussion with member states. Each time we have a new legislation, faster, for instance, there is a guidance and a discussion with member states. It would be useful to have guidance also for some existing pieces of legislation, but here, by definition, it will take much more time. It's much more difficult because member states have already legislated, have transposed, have their own interpretation. So we start from a point in time where we have diverging interpretation. That's why the best moment in time where to do it is when you have a new text just adopted, no one has any interpretation, no one has any guidance. That's the point in time where we should try to sit around the table and agree collectively on the guidance and make it public. And even if it's not binding, because I unfortunately do not think it will be politically possible to make it binding, de facto it is very influential. And when courts will be looking for the correct interpretation of some article of a directive, by definition, they will also have a look at the common guidance on the website, which will have been agreed. So it will have an impact.
But it would be more an informal thing. You don't see a VAT-like committee.
But again, the VAT committee, Elodie, is not binding. I know it because when I was acting in indirect taxation, I tried to make it binding, and we failed. We failed to gather the support from member states. And as Kira mentioned, the unfortunate experience of the transfer pricing directive, we witness a lot of reluctance of member states to tie their hands up front in a binding interpretation. At the same time, we have had a number of discussions those last months with member states on having a systematic effort to have guidances, and the European Parliament is not the only institution asking for it. The European Court of Auditor, for instance, in its last report has come with exactly the same request, and no member states has said, no, we don't want it, actually. They all value and see the usefulness of having this systematic effort of having discussed in common interpretation and guidances on how they should implement union law. But as said, it's easier to do going forward than backward.
Sorry, I just have one follow-up on this, because if I don't know what the status of the Pillar 2 guidance is, if it's a Commission guidance or if it's a Council guidance, but I guess if the court has to look at interpretation, it's stronger if it's Council guidance, right?
No, it doesn't change. It's just an interpretative value. When you have a question mark,
Okay.
it helps you taking a decision on what is the correct interpretation.
Okay. Quickly, is there any question from the audience? Saim? And then we have another one here. And I think that's it.
Hi, Saim Said from Bloomberg News. I had a question about DSTs because President Ursula von der Leyen said that they might be a part of the retaliatory measures that the Commission is considering. My question is, how would that happen? And do you have consent among member states to do that?
I guess this is for the Commission. Shall we take the second question at the same time?
Hi, my name is Severine. I come from the Labour movement, and it's 2 reactions rather than questions.
Right.
The first one is on Pillar 2. I have to say it's getting frustrating to see that the international tax architecture is a ping-pong match between the EU and the US, and strongly encourage the European Union to look for friends and allies outside North America, because the world is a complex place. And my second comment is in relation to the tax incentives. From a Labour point of view, this is an absolutely essential area. I've heard several of the speakers expressing concerns that there are some tax incentives for which there are more costs than benefits, but it's difficult to convince policymakers to withdraw those tax incentives. I just want to make a plea here to say that there should perhaps be more, let's say, cooperation between the EU and the labour and workers. Workers' representative will be the first one to tell you where a tax credit actually ends up in productive investment and where it disappears into some complex financial architecture. However, there is no such connection being made today, and so this is a plea really for policymakers in the Commission, in the Parliament, to reach out to workers' representatives at the workplace level, because we can tell you quite a great deal in terms of effectiveness of tax incentives.
Okay, thank you. I think there's no more question, right? I'm not missing anyone. Okay, so I'll give the floor to the Commission, I guess.
I'm not sure I can answer Sami. The President has mentioned it indeed as a possible countermeasure. So as you can imagine, whether or not countermeasure will be used will depend on the ongoing discussion in the trade arena and what the situation will be at the end of the 90 days period. I cannot say more.
Okay, well, thank you to all the panelists, and thank you thanks to the EU Tax Observatory to organize this event, and I'll give the floor back to Julia.